When an AI-driven investment boom collides with a more hawkish Federal Reserve, every major asset class has to adjust. Welcome to vTalkInsight, Allocator's Lens Daily for June 23, 2026, where we connect the dots across equities, rates, credit, currencies, and commodities from an allocator's perspective. Let's begin with equities, where powerful earnings and stretched valuations are pulling in opposite directions. In equities, the core tension is between an AI-driven earnings boom and increasingly demanding valuations and supply. Portfolios that are heavily equity-centric now have to weigh powerful structural growth against late-cycle signals and policy uncertainty. Across the United States, technological innovation in artificial intelligence, robotics, and even quantum computing is expected to lift trend growth from around 2% toward 4% by the end of the decade. Unlike the dot-com era, today's AI leaders are already generating substantial profits, which reinforces the idea of a more grounded productivity boom rather than a purely speculative story. That growth backdrop is feeding directly into earnings. Analysts see sustained earnings momentum, powered by AI-related capital spending and a broadening list of sectors, with the potential for multiple parts of the market to deliver double-digit profit growth. Emerging markets in Asia illustrate this, with chips and hardware demand driving roughly 30% gains year-to-date and earnings growth expectations closer to 50%. Market leadership is also rotating. Equal weight versions of the S&P, the Russell 2000, and stocks like Eli Lilly are making new highs, while cyclical and economically sensitive sectors have outperformed even as the headline S&P 500 NASDAQ have recently lagged. Within technology, AI-focused memory and chip names such as Micron have outpaced mega-cap platforms, helped by supply bottlenecks in DRAM and data center hardware. Against that healthy earnings picture, the supply side is becoming more challenging. Valuations near 23 times earnings and very rich multiples for AI semiconductor stocks signal limited margin for error, while indicators of market exuberance are at their highest levels since the global financial crisis. At the same time, cash balances relative to total equity market value are near historic lows, just as a wave of large AI-related initial public offerings and over $8 trillion of private company value prepares to come market. Large technology buybacks are slowing, lockup expiries are adding secondary supply, and new issues will likely be funded through rotation out of existing winners. There is confidence in some quarters that public markets can absorb this through rotation, buybacks, and mergers and acquisitions. Yet the combination of low cash buffers and heavy issuance raises valid questions about absorption capacity. Macro conditions add another layer of complexity. The scale of AI infrastructure and energy transition financing, including recent deals in the tens of billions of dollars, is straining capital markets even as it supports growth. AI investment could ultimately be disinflationary through productivity, but in the near term it is contributing to higher demand for power, copper, and critical minerals, feeding the very inflation volatility that keeps central banks hawkish. With inflation expected to stay above 3%, the risk grows that stocks and bonds move in the same direction, reducing diversification just as equity valuations look full. For allocators, that puts the focus on the durability of earnings breadth, the path of upcoming AI-related IPOs, and how much volatility a still relatively calm options market can absorb if the next inflation print or policy surprise disappoints. Turning to rates, the dominant story is a shift toward higher for longer policy expectations in the United States, paired with greater uncertainty about how the Federal Reserve will react to new data. This matters because it directly influences discount rates for equities and the cost of capital across the economy. Major banks now project as much as 75 basis points of additional rate hikes, with some expecting moves in September and December and others looking for 3 increases starting later in the year. Fed communication has turned more hawkish in a year-end, prioritizing tighter policy despite still solid growth, and Treasury yields have pushed to yearly highs even as Brent crude has fallen sharply. In contrast, some strategists expect the Fed to remain on hold through 2026, arguing that AI-driven productivity gains and labor market risks could justify patience. Upcoming personal consumption expenditures inflation data is central to this debate. Core PCE is expected to print around 0.3% month-on-month and 3.4% year-on-year, above the Fed's target, and there is a risk that both the monthly and annual figures accelerate. Such an outcome would reinforce the case for further hikes and could trigger renewed volatility, especially as markets already anticipate persistent inflation swings over the next 6 to 12 months. The yield curve has flattened, with the gap between 2- and 10-year treasuries narrowing to under 30 basis points, signaling skepticism about long-term growth even as near-term inflation stays firm. At the same time, declining treasury buybacks and faster bank lending growth are raising questions about dollar liquidity, all against a backdrop of rising developed market debt and limited political appetite for fiscal consolidation. Yet when geopolitical tensions spike, U.S. treasuries still attract safe haven flows, underscoring their central role in global risk-off episodes. In the United Kingdom, 10-year gilts are trading in the cross-currents of global Fed-driven moves and domestic politics. Yields have sold off on signs that Andy Burnham could become prime minister with a more expansionary fiscal agenda, then partially retraced as markets reassess the likelihood of very loose policy and judged a repeat of the 2022 crisis as unlikely. With fiscal rules pointing to future consolidation but front-loaded capital spending already in the pipeline, the outlook for gilts hinges on how the new leadership balances growth ambitions, deficit targets, and the Bank of England's reaction function. All of these rate dynamics feed directly into credit, where the divide between resilient issuers and stressed borrowers is widening. Credit markets are increasingly two-speed. On one side, leveraged finance and parts of private credit are under visible strain, while on the other, investment-grade issuers and new economy borrowers still access capital on relatively favorable terms. This split is crucial for allocators assessing where downside risk and upside carry are truly coming from. Default rates in public loan markets have climbed to levels last seen during the global financial crisis, hinting at persistent trouble spots, particularly in private credit portfolios. Some funds have already restricted withdrawals after investors tried to redeem around $13 billion in a single quarter, and software sector loans are highlighted as a key vulnerability from the last cycle. Upcoming maturities for highly leveraged companies, combined with scarce capital, are expected to create more stress and a potential rise in so-called zombie funds. In contrast, broader credit markets, especially investment grade, are seen as relatively resilient, with systemic risk viewed as contained within the leverage segment. Private credit yields have compressed versus public benchmarks, but still offer a premium of roughly 150 basis points, reflecting both higher default risk and ongoing demand for diversification. Asset-backed finance is attracting interest because it provides clearer cash flow visibility than loans tied mainly to corporate revenue growth. At the same time, a new wave of investment-grade rated disruptors is tapping bond markets for long-duration capital, aligning with institutional appetite for stable, long-term assets amid a global retirement funding gap. SpaceX is emblematic, planning to raise around $20 billion in its first investment-grade bond sale to refinance debt costing more than 12% down toward roughly 4%, and to fund capital-intensive AI and satellite projects. Rating agencies still flag its AI business as the riskiest part of the group, underlining that even high-profile issuers carry idiosyncratic credit risk. Alongside multi-tens of billions in AI infrastructure financing, this surge in borrowing underscores strong capital demand and raises questions about whether markets can absorb it all without inflating asset price bubbles. How credit absorbs that demand has direct implications for currencies, particularly the dollar and funding-sensitive exchange rates. Foreign exchange markets are the main transmission belt for these rate and credit dynamics. The dollar index is firming as U.S. 10-year yields grind higher, signaling a cautious, mildly risk-off tone that is being reinforced by geopolitical and energy-related concerns. The yen is hovering near multi-decade lows against the dollar as U.S. inflation expectations rise and policy divergence between the Federal Reserve and the Bank of Japan widens. Traders are increasingly speculating about potential intervention as dollar-yen revisits levels last seen in mid-2024, and the pressure is spilling over into other Asian currencies. Sterling is also under strain. The pound is trading near its lows for 2026 after the resignation of Prime Minister Keir Starmer, with markets now focused on whether Andy Burnham becomes leader and, crucially, which chancellor he appoints. Investors are weighing the risk that higher fiscal, spending, and possible tax increases could unsettle gilts and the currency, even as recent moves in UK bond yields have been modest and driven largely by global factors. Medium term, some expect sterling to recover as political uncertainty clears, but in the near term, elevated volatility and sensitivity to headlines are likely to persist. These currency moves loop back into commodities, influencing local price dynamics for oil, metals, and gold. Commodities round out the cross-asset picture with a mix of near-term relief and lingering structural tension. Oil prices have dropped sharply, with Brent and WTI both lower on progress in the United States and Iran talks that include partial sanctions relief, asset unfreezing, and expectations of higher Iranian exports. Even so, tanker traffic through the Strait of Hormuz remains well below pre-war levels. Shipping insurers are updating cover decisions almost hour by hour, and crude and gas flows are still constrained. Markets have not fully priced in a breakdown of negotiations, so any setback could deliver an asymmetric spike in oil prices and potentially push bond yields higher again. Beyond oil, the AI build-out and energy transition are intensifying pressure on critical minerals. China, Europe, and the United States are all stockpiling key metals such as copper, while export controls from Beijing have reinforced concerns that supply chain disruptions could escalate if geopolitical tensions worsen. Despite efforts to diversify rare earth production, China retains significant leverage, leaving technology and defense sectors exposed to policy shifts. At the same time, producer price inflation remains elevated due to non-energy inputs, underscoring that inflation risks now extend well beyond crude. Gold is responding to this backdrop as both a macro and geopolitical hedge. Prices are rebounding after 3 weeks of declines, helped by safe haven demand tied to the fragile Iran peace process. Central bank buying has structurally increased since 2022, with annual purchases roughly doubling compared with the previous decade, providing a steady source of support even when tactical flows turn. Some research houses expect the Fed to keep rates on hold for an extended period, which, if realized, would shape the real yield environment in a way that often benefits gold. For allocators, commodity markets are signaling a combination of near-term energy relief, longer-term materials tightness, and enduring demand for hedges, all of which feed back into the inflation and policy path driving other asset classes. Pulling the threads together, today's cross-asset picture is defined by a powerful AI and productivity story that is lifting growth and earnings expectations, while a more hawkish and less predictable Federal Reserve tightens the discount rate backdrop. Equities still look supported by broadening profits and global capital expenditure, but they face richer valuations, heavier primary supply, and the risk that higher inflation keeps stock and bond returns moving in tandem. Rates markets are pricing a higher for longer profile with a flatter curve and rising liquidity concerns. Credit is bifurcating between stressed leveraged and relatively resilient investment-grade borrowers. Currencies are transmitting dollar strength against a fragile yen and pound, and commodities are offering both the disinflation of lower oil and the reflation signal of tighter metals and firmer gold demand. For multi-asset allocators, the key watch points from here are the upcoming PCE inflation data, evolving Fed communication under new leadership, the pace of AI-related issuance in both equity and debt, stress indicators in private credit, and the stability of the Iran energy framework and critical mineral supply chains. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.